Let's continue Chapter 31, Section 2. Let's talk a little bit more about how monetary policy really works. So we've talked about this a bit, but a central bank is a type of, you could think of it as a banker's bank. There's several things that central banks do, but one of the main things that they do is they provide services to the banking system. Particularly, they control the money supply, and then they facilitate other things such as transfer of payments, check clearing, those types of functions, payment processing, to allow banks to transfer funds between other banks. So the central bank in the U.S. is the Fed. So sometimes commercial banks need to borrow money. Oftentimes they will go to the Federal Reserve to borrow that money. So that if a bank needs to borrow money, it can either borrow it from its customers through, say, checkable deposits. So you put your money in a checking account, the bank is borrowing that money from you. Another place is it can borrow from other banks. All right? And we have a market called the federal funds market where banks trade reserves back and forth. So they trade funds, loans to one another back and forth. And then they go directly to the Federal Reserve and borrow money from the central bank. If there's a financial panic and a run on the bank, the central bank is there to make loans. So one of the purposes of at least the Federal Reserve and the Federal Reserve System is to be what we call a lender of last resort. In other words, the central bank, the Federal Reserve System, was actually created in response to some bank panics that happened. And there was this need to make a place where banks could borrow money if they absolutely had to stop from failing. The ability to create money gives central banks power and control over monetary policy. So the main power of a central bank is this monetary policy power. And the only way that they have that is if they have the ability to control or to create what we call this base money or outside money. So if we take a quick look at the structure of the Fed, we see there's the Board of Governors, and there are 7 members here. There's one who's appointed as the chair of the Board of Governors, one who's appointed as the vice chair of the Board of Governors, and then 5 other members. These are appointed by the President, confirmed by the Senate. So the Board of Governors actually represents the political arm of the Federal Reserve System. So we're going to talk about the Federal Reserve System being this kind of actually rather strange public-private partnership. And this is the public part of it. There's 12 regional banks or federal bank regions, and each one of those banks, each one of those regions has a Federal Reserve Bank. And within those regions, there's also branch locations. That's a little less important to worry about for right now, but there are 12 Federal Reserve Banks throughout the country. Now, the Federal Open Market Committee is really the partnership between the public or the government part of the Fed and the private part of the Fed. So these regional banks are actually private organizations that are owned by those banks that are members of the Federal Reserve System within each bank's district. And they work like a private organization. They have a board of directors, they have a president, and each one of these 12 presidents, each one of the 12 Federal Reserve banks has a president, which is appointed by its board of directors. And it comes together here. The Board of Governors plus 5 Federal Reserve presidents, one of whom is always the Federal Reserve, the bank president of the Federal Reserve Bank of New York. All right, he's always on here, plus the 7 Board of Governors, plus 4 other presidents, which rotate throughout the remaining 11 district banks. So we see here that this Federal Open Market Committee, which is the main policy-making branch of the Federal Reserve, is composed of 1, political appointees, such as the one you've probably heard is the Federal Reserve Chair, who is currently Ben Bernanke. He is appointed by the President and confirmed by the Senate, plus 5 Federal Reserve presidents. So you can see this public-private partnership coming in here. The Federal Open Market Committee then makes policy decision, which directs which they direct to the district banks who actually carry out those policies. Main duties of the Fed are, number one, to conduct monetary policy. Number two, supervise and regulate financial institutions. They have a major regulatory role in our economy. Three, they act as this lender of last resort. So if a financial institution has no place else to borrow, oftentimes they will go to the Fed. Provides banking services to the U.S. government. So another major reason why the Federal Reserve came to existence was that the U.S. government needed, well, for want of a better word, an investment banker. So I don't know if you know what an investment bank is versus, say, a commercial bank. Well, a commercial bank is like what we used to dealing with. It's where we have our checking accounts and we go to get a car loan or a mortgage loan, stuff like that. An investment bank is something very different. An investment bank actually provides banking services to big companies who need to do things like issue bonds or issue new stock. Well, the Federal Reserve acts like the United States' investment bank. So when the U.S. Treasury decides it needs to issue more bonds, it issues those bonds, gives them to the Fed, and the Fed then sells them for the U.S. government. It also, if you notice, if you ever get a tax return and you actually get paid with a check, it will be a check drawn on the Federal Reserve. The Federal Reserve is the U.S. government's, the federal government's bank. They also issue coin and currency, yes. Provide financial services to commercial banks, savings loans. So there's a couple of different services, one of which is called FedWire. That's a way that banks can transfer large amounts of money from one another to another. They deal with check clearing, with payment processing, generally day-to-day stuff of banks doing business. They help with that. So particularly what we want to talk about in this section is this conduct of monetary policy. So how does the Fed do that? The Fed does that primarily by interacting with this monetary base. They control how much base money, or if you want to call it outside money, is in existence within the economy. So generally monetary base is made up of vault cash and deposits at the Fed, as well as currency in circulation. Now, the only thing that can count towards their required reserves, right? Banks have to hold a certain amount of required reserves, is, of course, this deposits at the Fed. But these other things also, a vault cash would also count as reserves for the bank, and then currency in circulation, that makes up a part of the monetary base as well. So monetary policy affects the amount of reserves in the banking system. And that's really what we're going at. So I might use interchangeably monetary base and reserves, and that's actually not even close to correct. There is a little bit of difference, and the difference is, well, currency in circulation. But oftentimes the Fed will focus solely on reserves, mostly because the currency in circulation is actually a pretty small percentage of the overall money supply, and it's not as significant, at least in current times, as the vault cash and deposits at the Fed that banks hold. All right. Yes, reserves or vault cash or deposits at the Fed, but to be counted as against their reserve requirement, it has to be deposited at the Fed. So there's a market for reserves. So banks have to hold a certain amount of reserves. They're required to. And then they have to hold a certain amount of reserves over on top of that called excess reserves in order to do business. So banks will regularly trade back and forth. And so, and this is something that has to happen properly on a daily basis. So a bank might have $200 million more than it needs. Well, you say, well, that's cool. It's got more than it needs, right? No problem. Well, except $200 million is an awful lot of money to be laying around for any period of time at all, right? I mean, just figure out what the daily interest, if you could earn, say, 2% annually. Well, take 2% of 200 million and divide it by 365 and see if that isn't a number that's big enough that you would say, hey, I probably better figure out some way to take advantage of that. Well, banks do take advantage of that. They have something called the federal funds market, where banks will trade back and forth reserves. So your bank is $200 million too much. My bank is $200 million too light. All right, they don't have enough to make their reserve requirements, so they say, oh, well, we probably better buy some reserves. And so what they do is they go out and they borrow. The one bank borrows from the other bank, and everybody's able to manage their reserves well. Well, the main tool of monetary policy that the Fed uses is called open market operations. And open market operations essentially is the Fed messing about in that federal funds market. So the Fed either buys reserves, in other words, it sells bonds and takes reserves out of circulation, right, reducing the supply of reserves in this federal funds market. That would be a contractionary policy. Or they buy bonds, buying bonds and putting reserves back into it, increasing the supply of reserves in the federal funds market. And by that, they can adjust how much reserves are in circulation and affect the monetary base, which in turn affects the overall money supply. So let's define that specifically. Open market operations are the Fed's buying and selling of government securities. To expand the money supply, the Fed will buy bonds. Why? Because it takes bonds out of circulation and puts money into circulation, which will increase the amount of money in circulation. To decrease the money supply, it sells bonds. So why? Because if I sell bonds, I take money out of circulation, put more bonds in circulation, and so that means there's less money out there, so we have a smaller money supply. So an open market purchase is expansionary monetary policy. All right, it tends to reduce interest rates and at least temporarily increase aggregate income. It's a stimulant to aggregate demand. All right. When the Fed buys bonds, it deposits money in the bank's account. Bank reserves are increased. When bank reserves increase, they can lend out more money, and so goes the process. An open market sale is contractionary monetary policy. It tends to raise interest rates, lower aggregate demand, at least temporarily. When the Fed sells bonds, what does it do? It receives checks drawn against banks, so it reduces those banks' accounts. So the banks have less reserves. Because the bank's reserves are reduced, the money supply decreases because the banks have less to lend. So we've talked about the reserve requirements. All right, the Federal Reserve requires that banks keep a percentage of their deposits on deposit with the Fed. All right, they have to have a certain minimum amount. And given that, we knew that the money multiplier was this. We discussed this in a previous lecture. Right, where R is this required reserve ratio, or is the reserve ratio. C is the currency ratio. All right. Well, if the Fed changes the money supply, all right, what is it going to do? It's not going to change the overall money supply. It's going to change monetary base, right, by either issuing more reserves or taking reserves, draining reserves out of the economy. And whatever it does is going to have this multiplier effect. So if I increase monetary base by $100 and the money multiplier is 5, the overall money supply is going to go up by $500. So the Fed has to take into account not only how much it wants to increase the money supply, but this money multiplier so that it can actually achieve that increase. All right. In the case of a shortage of reserves, a bank can borrow directly from the Fed. All right, this is called the discount window. So the bank, and back in the old days, the bank would actually have to go to the Federal Reserve, and there would be a window there, a teller window, and they would do the business right through that window. And that's why it's called the discount rate, and they borrow from the discount window. It doesn't work that way anymore. It's all electronic and much cooler than it used to be, but it is now. It used to be that way. And that's where some of these terms come from. But the discount rate is the rate that the Federal Reserve charges for direct loans that it makes to banks. So the Federal Reserve really has only control over this one interest rate. And that's not exactly true because there's lots of different borrowing facilities that the Fed has started over the years. But really, they all come down to this. They're direct borrowing from the Fed. You have this discount rate, and that's what they charge. And this is really the only rate they can set directly. All the other rates, they have to interact in the market to try to get the market equilibrium to be what they want it to be. All right, if they increase the discount rate, it makes it more expensive to borrow from the Fed. If they decrease the discount rate, it makes it less expensive to borrow from the Fed. This really isn't that important because it's not used that much. Although, over the course of the financial crisis, so 2008, 2009, starting into 2010 a little bit, there was actually a great increase in discount lending because that federal funds market I talked about really stopped working. And so the Fed then became the only place banks could borrow. All right, so banks with surplus reserves, they want to lend that out. They do that on the Fed funds market, like we talked about. So this rate right here is actually a pretty important rate when we talk about monetary policy. It's the Fed funds rate. It's what the Federal Reserve uses as what we'll call an intermediate target. All right, so we'll give it just a second, and then I'll talk a little bit more about targets in a second. So by selling bonds, the Fed decreases reserves, causing the Fed funds rate to increase. By buying bonds, right, it causes it increases the amount of reserves, causing the Fed's funds rate to decrease. And this is the main mechanism through which open market operations work. So if we plot out that's the discount rate. And that's what we call the effective Fed funds rate. You'll notice that they track one another very, very closely. If you take money in banking, I'll show you some theory that explains why they need to track each other very closely. But for right now, just realize they kind of track fairly closely. And for the most part, although this time period's a little weird, if we come in, for the most part, the discount rate is just a little bit above the federal funds rate. So we can have two basic strategies towards monetary policy. Defensive policy, these are simply decisions that maintain the current policy. All right, these have to happen, almost on an hourly basis. Interest rates a little above target. Okay, let's change things a little below. All right, and they just little fine tunings to make sure that whatever the policy target is attained. All right, offensive actions are designed to actually change the interest rate to a new target. All right, so we'll see offensive monetary policy whenever we change the target. So, and defensive whenever we just want to keep things the same. So, what is this targeting that I talk about? Well, first of all, we see monetary policy affecting interest rates. So we need to break this down and figure out, number one, what do we want to happen? Well, the first thing we want to happen is we want stable prices and sustainable long-run growth. All right? Then another goal would be low interest rates, although that's secondary. All right, we want price stability and economic growth. So we could flip that around and say we want price stability, so low inflation, and low unemployment. Okay, but that's great. That's good to know where we're going. But, I can also say I want to go to New York City. Well, how do I get there? I need a map, right? I need a either go to the airport and fly there, or I need to take this road and drive there, right? Well, we have these intermediate targets that we use for that. So the Federal Reserve looks at the Fed funds rate as this target to determine whether or not monetary policy is doing what they want it to do or not. So essentially, the way it works is this. For the most part, the Federal Reserve takes a look at inflation. All right? What's the price level doing? Are prices growing or are prices contracting? And it says, wait a minute, I think prices are growing a little too fast. So then it'll take its target for the Fed funds rate, because it doesn't set the Fed funds rate directly. It sets a target, and then the New York Fed, the Federal Reserve Bank of New York, goes in and makes adjustments. They either buy bonds or sell bonds in order to get the Fed funds rate to be the exact rate they want it to be. But the FOMC comes and looks at the overall economy and decides, should we make our target for the Fed funds rate higher, lower, or stay the same? If they decide to make it higher, then they tell the New York Fed to contract the money supply until the Fed funds rate is higher. If they want to make it lower, they tell the New York Fed to expand the money supply until the Fed funds rate is lower, right? And they set this target based on where they think they are in terms of inflation, but also where they are in terms of unemployment. So oftentimes what you'll hear is the Fed balancing two different risks. The upside risk of inflation, in other words, when we're in an economic expansion, we have low unemployment. What's the risk? Inflation. That's why we call it the upside. And the downside risk of recession, which basically means we're worried that the economy is going slowly enough that we're going to start having excessive unemployment. All right, so upside risk of inflation, downside risk of unemployment, essentially. And the Fed is constantly balancing these two because I can minimize the upside risk of inflation, but that might also maximize the downside risk of unemployment, and vice versa. So maintaining low unemployment and low inflation, well, those two goals might be contradictory from time to time. So the Fed has to balance those. So the Fed will make the decision, well, we think the downside risk, and this is probably their thinking right now, the downside risk of recession or of excessive unemployment is greater than the upside risk of inflation, so we're going to keep the monetary policy fairly loose. All right, so whenever the Fed sets a target for the Fed funds rate, and essentially what we're seeing here is the FOMC will direct the New York Fed, all right, and that's where open market operations happen, is the Federal Reserve Bank of New York. That's why the president of the New York Fed is always on the FOMC. We'll see that they will direct the New York Fed to take actions to affect that interest rate.